What happens when the United States hits 38 trillion in debt? We call our main man, Bryce Gill, today on the David Rutherford Show. All right, ladies and gentlemen, boys and girls, I keep getting a lot of the requests. So, and with what happened yesterday online and the absolute hysteria that just ripped through X at every single level of hitting 38 trillion, putting on $1 trillion in debt every month now. The Democrats want to add 3 trillion to the deficit. The Republicans want to add 2 trillion. There's all kinds of chaos. Meanwhile, the markets are going through the roof. Gold's at an all-time high. I'll tell you what, I'm too much of a knuckle-dragging meathead to figure this out. So based on your request, we reached out to the man, the myth, the legend, ladies and gentlemen, boys and girls, children of all ages, Mr. Bryce Gill. Bryce, how you doing, buddy?
I'm doing great, man. It's great to be with you again. And lots to talk about, obviously.
All right, let's just start at the main issue that just pulls everybody's attention away from investing, long-term ideas, the whole thing, and that's the nature of hitting $38 trillion. What are you and your team thinking about? I know your main economist that you work with is been very vocal about that as of late, and that we're not addressing those issues. What are your thoughts on what that number means, what it means short-term, long-term, and what do you think how the markets are going to react?
Yeah, it's so hard to really say because obviously the size of that number is crazy. It's impossible to really fathom actually what that means. And so, there were economists years ago, Reinhardt and Rogoff, this is after 2008, 2009. They did a study. They looked at governments all over the world, looked at all the history of government debt, and basically came to the conclusion that when an economy hits about 100% debt to GDP ratio, which we're past that now, right? Mm-hmm. That's when empirically it starts to slow down your economy, cause problems, right? Put you at risk of like a debt crisis. And so, hey, we're past that point. The one thing that is kind of the fly in the ointment here, the thing that makes it really difficult to analyze this is that the United States is not a normal economy, right? The reality is we're the biggest empire in world history, right? And so the dollar is the reserve currency. By the way, it's by far the dominant reserve currency in the world. I just looked at today, 50% of global transactions are in the dollar. The next highest is like the euro at 20, right? So we're 2.5 times the euro. So there's nobody even nipping at our heels here. And so it makes it hard, right? Because it's like, hey, we're past the point where it normally would cause problems, but everybody's sort of cemented into this dollar system. There's really no better alternative. I mean, you look all around the world, like Europe is in worse shape than us. China's has a ton of problems. Nobody wants to own the yen. That economy's been stagnant for 30 years. And so people are kind of just stuck with the dollar. Now, that all being said, really the problem here is not like the overall level of debt. What kind of worries me more is the interest payments we're making every year on it, right? So today interest is like $1 trillion a year in the United States. It's not like the highest level as a percent of GDP or the budget or any of these things so that it's been in modern history, and it's set to go higher from there. And so we're just throwing money in the hole of interest. And unless something's kind of done about that, it just continues to weigh down current growth, right? It causes problems because when I pay interest, I'm not getting anything for my money. I'm basically paying back the money I already borrowed. So it worries me. I think there's maybe a couple bright spots around, hey, we're reducing government employment, right? The tariffs are bringing in a lot of money. I'm sure we'll talk about that a little bit. But big picture, this is all about the baby boomers. It's all about Medicare, Medicaid, Social Security. That's 70% of the money we spend at the federal level is on those programs. And so ultimately, Dave, like it fixes itself. Like these people, will eventually pass away. Like it won't be such a top heavy economy, but until then, we kind of got to carry this weight of entitlements in the United States. And thankfully, everybody's sort of stuck with us and keeps lending us that money.
Awesome. Thank you for that explanation. One of the things that I think when people hear about the interest payment, where does that interest payment go? What organization, entity, what bank, what system is taking that $1 trillion from America? And I think a lot of people don't understand how that works either.
Yeah, so it used to be like a lot of that money would go abroad, right? The Chinese owned the debt or the Japanese owned the debt, and they still did. Like, don't get me wrong. So we'd actually pay interest and it go abroad to some foreign investor, right? Today, foreign investors are a much smaller portion of the overall debt. About 30% of it's held by the Social Security Trust Fund. Mm-hmm. So when we pay it, it just goes into Social Security. I want to say 15% of it's held by foreigners, roughly. And then the rest of it, so like the biggest chunk is held by investors, right? And it's held by all kinds of investors, but generally speaking, like as you age, you get older, you sort of shift away from equities and towards fixed income. And so the vast majority of the US debt is frankly held by like wealthy, older people, right? So it's not just that we pay them Social Security and we pay for their healthcare. Like this $1 trillion in the national like interest payments we're making, that's going to baby boomers mostly as well, right? So a lot of the budget's just devoted towards the older generation in the United States, and that's fine. Like if that's the priority we want to have as a country, I guess where I kind of get a little bit concerned with that is like any nation that's focused on the oldest generation, not on the youngest generation or the next generation coming up, it has a shelf life, right? Like I think we should be focused more on young families that want to be having children or schools or whatever infrastructure or whatever else, instead of just making sure the oldest and like empirically speaking, wealthiest demographic in the country has even more support.
That's brilliant. I couldn't agree with you more. And I think you're starting to see a cultural shift towards that, right? And the narratives that are playing out and what younger people are being more outspoken about, whether it's the inability to, pay for their insurance premiums, or it's an inability to find great jobs, or an inability to, get their own home loans, to be able to start that nuclear family and start that long-term commitment to the system, if you will, right? Last time you were here, we just had an update about what you thought, how tariffs were doing. And can you just touch on that right now? Where are we as a country? We see all these headlines about, we have multiple trillions of dollars, $3 trillion of investments that have come, strangely from Middle Eastern countries right. That, seem to have to want to play some new role in the redevelopment of Gaza, or whatever just markets that they can get access to now. We see a lot of that. So, where are the tariffs, in your opinion? How are they impacting the country as a whole, and how are they impacting the average investor?
Yeah, so generally speaking, listen, I've always said I don't think tariffs can have a big enough effect to cause a recession, and that's because 70% of consumer spending in the United States is what we call services. So it's me and you talking on this, it's going out to eat, it's getting a haircut. It's things that are provided by Americans to other Americans locally and domestically. It's not touched by tariffs. The other 30% is goods. Only a third of those goods are imported goods. So we're talking 10% of consumer spending on the United States is on imports of any kind. And then about 50% of that trade is exempt from tariffs because of like USMCA or whatever else. So like a nice round number to give you, Dave, is that 5% of consumer spending in the United States is subject to tariffs. Okay. And we care about consumer spending because it's the biggest chunk of GDP. So it's really hard for me to see how like 5% of consumer spending gets us to a recession. And, when we really think about it, who buys imported goods? Okay. It's not people that are price sensitive. Factually speaking, wealthier individuals buy more imports. And so this is basically a progressive tax that hits wealthier individuals that are less price sensitive, is kind of the bottom line here. And so I'm not really concerned about it causing a recession. We can talk about the slowdown in like the jobs reports and kind of what I think is going on there if you'd like to.
Yeah,
but generally speaking, okay, what we're doing is we're leveraging our consumer market, which we are the biggest, most dominant consumer market in the world. You need us as customers. I think we're 40% of global consumption. And we're saying if you want access to these rich consumers to sell to, well, there's going to be, a couple loopholes you have to jump through. You want to sell, pharmaceutical drugs to the United States consumer base. Well, guess what? You need to build a factory here. You want to, sell your semiconductors to United States companies, you're going to have to build a factory here, right? And so you mentioned, I think, like a $3 trillion number. I've heard up to $6 trillion.
Wow.
A lot of it's PR, frankly, right? From what I can tell, kind of the best number I've seen is that the actual projects that have broken ground, and again, it's going to take years for all the spending to happen, right? But it looks like about $1.5 trillion.
Oh, wow.
Actual spending has begun. It's not all going to happen this year from the tariffs, okay, or at least like adjacent to the tariffs. So think pharmaceutical facilities, think semiconductor manufacturing plants. There's a whole host of other things too, right? Auto plants. And like I think Ford is talking about gearing up production here. Stellantis, the company that famously ruined Jeep as a brand, right? They're moving a bunch of production back to America. The list is very long. So I think it's just factually true that, yes, tariffs do cause companies to, on the margin, change their behavior because they need us as consumers over here. And so when you really hear like a lot of the analysis around tariffs, it's like, hey, it's going to hurt consumer spending, right? And again, I sort of like highlighted why I think that impact, whatever it's going to be, is pretty small. And by the way, we haven't really seen any evidence that it's happened yet. But the sort of hope would be, yes, the consumer spending portion of GDP, maybe that slows down a little bit short term, but then all this CapEx happens that sort of offsets it, right? All the investment in factories and plants and equipment. And then those hire Americans are paid well in these, new, well-equipped factories. And then that, keeps all the spending domestically in the United States. So I think ultimately this is going to be a positive for the United States. I know it's chaotic right now and global supply chains are shifting back here after 80 years of going abroad. And so there's going to be some bumps in the road, but it looks to me like, yes, the tariffs are working and having an effect so far.
That's great to hear, because that was the big concern we talked about last time, was this reshoring of jobs, right? Able to, take this middle class that was offshore and dissipated and now bring it back to give, like you said, a person that doesn't have to have, and we were just not joking, but Jordy and I were talking about student loan debt and, for jobs that really don't, they don't exist, right? It's not a service-based job if you, have a liberal arts degree and, an African basket weaving. So, the idea is, as these companies onshore, it becomes a more productive gain for those young people that are looking for those better opportunities at that American dream. Now, one of the things that I constantly hear about on the road is this idea of, as those boomers time out, there's going to be this massive transfer of wealth, what as low as 30 trillion, as high as 70. Someone said to me yesterday at an event in Houston, and that's a massive number. What do you, based on where the market is right now, which is at an all-time high, and can you give us a little description of why that is, and then what you think is going to happen as a result of the shift in that wealth? Will it stay in the right places? Or I know Jordy's got a couple questions for you here in a second about gold and Bitcoin and how, like you said, what is the future of the next generation going to look like from investment, from spending, and then also from saving? How is that all going to look like in your mind? That was a lot.
Yeah, well, when you think about how it's like happening, right, it's basically, it used to be like we just did the jobs that our parents did, right? So if my dad is a baker, I'm going to be a baker. If my dad makes, the barrels, right? That's what the last name Cooper comes from. I'm a Cooper, right? I make the barrels. Up till to current day, it's right. I'm a veterinarian because my dad was a veterinarian, or my dad had an orthodontic practice. So then I went to school to be an orthodontist. What's kind of happened recently, and I think social media is a big part of this. I think there's a whole host of things happening, is that basically nobody wants to continue on the family business anymore, right? Statistically, a small amount of people do. And so you have these older people that are retiring. They want to pass on their kids, but their kids aren't really interested. And so instead, what they do is they go and sell it to a private equity firm. And this is happening in basically every industry, Dave. Like, I talked to my barber recently. Okay, my barber went independent, and now he's just working out of it like his own little studio or whatever that he rents. But he's like, yeah, that barbershop I was working out of, they got bought by private equity, right? So private equity is buying barbershops now.
Oh my God.
And basically, it's good right now in the sense that it makes the economy a little bit more resilient because, hey, that baby boomer that retired just got paid a bunch of money, right? And by the way, Dave, like I talked about the baby boomers a little bit earlier, statistically speaking today, people 65 and over, retired people, for the first time ever in U.S. history, are the largest consumer demographic. Wow. They spend more money than anybody else. Historically, that was, we always talk about like the 35 to 54 was the key economic demographic. People are buying houses, starting families, sending their kids to college, buying washing machines, buying cars. Today, it's baby boomers.
Wow.
Baby boomers spend more money. They're 22% of consumer spending, retired baby boomers, I should specify, 65 and over. So they're getting paid out by private equity. Private equity is rolling all these small businesses up into bigger umbrellas, right? That's why service is going down in like everything. You're paying more and the quality is lower, it seems like, right? So private equity is buying all this stuff. I worry down the line, like this ends up being a bubble, right?
Right.
Private equity, one guy in New York can't run every barbershop in the continental United States. It just doesn't work that way. And so the bad news, right, is like, hey, in short term, it makes all these small businesses kind of worse service for the money that you spend. I think ultimately there might be like a financial bubble in some of these private markets eventually. Now, most of us don't really invest in private markets. We don't have the ability to do that. But ultimately, it creates a ton of opportunity for entrepreneurs that basically can come in and like, hey, your barbershop is terrible now. I'm going to create a new model that's better. And I'll steal all the business, right? So it used to be, hey, you just pass on the family business and your kid like ran it into the ground. Today, at least you're getting paid out by Wall Street, I guess, and they're selling it to some investor and maybe he'll lose his shirt. And then hopefully the next generation, and I think there are a ton of Gen Z people and younger millennials that are like willing to pick up the reins and be the entrepreneurs here. But it's sort of a different way to transfer wealth than ever before, right? Because institutionally, like Wall Street's very involved.
Mm-hmm. That's the fascinating aspect to me. Is you would like they traditionally what Wall Street provided the service of this long-term approach to investment, the slow growth on your portfolio, right? You just keep they're now proactive and they're getting into, like you said, every industry, whether it's the housing market, which I just, watched a long video this morning about, this person's theory about how BlackRock is through shell companies buying houses, right, at an elevated price and then coming in, elevating the market for that area. And then so the people that are selling their house at the highest price get out and they can't afford to go into another house. So they end up renting the house they just sold, right? And it's right. this twisted. So there's a lot of that's in play with, I think, these various markets and what the P&E firms are gobbling up. Is that having an impact on the market itself? Is that why we're seeing all-time highs right now? Or what's your theory behind why the market is so healthy?
Yeah, I mean, I wouldn't say necessarily the market's that healthy, right? At least we're talking about like the public stock market, the S&P 500, for example. Okay. If you look at like valuations, so just compare like the multiple or like the price of a stock to the earnings that it's actually earning, things are very expensive. And the other problem is that there's like 7 stocks that have driven everything for years. And so it's really like AI that's kind of driven a lot of this, right? It's this narrative around AI changing the world. And I ultimately think it will do that. But this just looks really frothy to me and kind of worrisome, to be honest. And when you read about how these companies are all, it's like a giant self-reinforcing loop. They're all like lending each other money and buying each other's products. So like, NVIDIA will go out and invest in CoreWeave, right? They give them money, they get CoreWeave stock. Then CoreWeave takes that money and buys NVIDIA chips, right? And so, like NVIDIA's sales go up 25%, but it's their own money that basically did it. And now if anything doesn't work out, they're all tied together as like one big thing, right? So it seems a lot like 2001 to me, to be honest. I understand the companies have earnings, but their earnings aren't coming from AI. It's like Microsoft's able to pay for AI because they have, web services, they have legacy software sales and things like this. So it's the AI sector that just looks really kind of worrisome to me. The other thing I'd point out is like, you mentioned the houses. I talked about PE. Okay. What you're basically seeing here is like the end game of financializing an economy, okay, which is what happens when you're the global reserve currency. And so part of the reason why I feel we need to sort of like pare back globalization a little bit, focus a little bit more on national development, is because when we run a trade deficit, which today is about $1 trillion, right? The old school idea, if you like open the Wall Street Journal or like read the Cato Institute or something, what they're going to tell you is, hey, it's great. We give them dollars that we print and they give us stuff they worked really hard for to make, right? But that fundamentally misunderstands what's happening because we're not just giving them dollars, right? They take those dollars and they buy things with the dollars. They buy assets, right? Mm-hmm. We're not trading them dollars for goods. We're trading them ownership of national assets for goods. Okay. And so the dollars go abroad, then the Chinese, the Saudis, whoever take those dollars, they buy the S&P 500. They buy, BlackRock buys all these single family homes and rolls them up into a fund. Who are they selling that to? I don't buy BlackRock single family home funds, right? The Saudi royal family does. Who's investing in the PE firm that's buying all the barbershops? It's probably a bunch of like foreign investors that want access to the US consumer market, right? So I think part of this is the trade deficit. And I feel for young people, man, because, there's a whole, we could talk about housing and supply and demand and everything else. Okay. The part that's never talked about is like US housing supply, especially in places like big cities, which you can buy a cheap house in America, right? Go 45 out rural, you can get $100,000 house, no problem. Okay. Housing is expensive in the places with the jobs in the big cities. That's where people invest money, right? And so you're competing with the entire world because US homes are an international asset class. Nobody's buying Argentinian homes, right? No one's buying homes in, Malawi. U.S. housing is an international asset class. That's why it's so expensive. Right. It's one of the reasons why. It's why all our assets are so expensive. It's the trade deficit that does that. And that's why, hey, Donald Trump throws a bunch of tariffs on. People get worried about this trading system. Oh, no, is the trade deficit going to decline? Because that structurally lowers demand for U.S. assets. Not that it won't be valuable anymore, but all the foreign money doesn't just pour in a bigger and bigger amount every year.
Got it. All right. Thank you for doing that. All right, Jordy, your turn, buddy. I know you're chomping at the bit to ask Bryce about several different things. Go ahead, man. It's all yours.
All right, great. Yeah, I could ask you a million questions, but I'll just start with a few. Just one quick comment on the housing thing. My wife and I we're renting right now. We looked at a couple suburbs around the Raleigh area, North Carolina, and median home price in a lot of these places is $670,000. Yep. And I'm like, holy cow, that's pretty crazy. That's the median. Anyway, I think a good place to start is following up with something you said about the AI stuff. A lot of people are wondering, are we in some kind of bubble right now? And you did touch on it. One, do you think we're in a bubble? But then two, I've heard an argument that you might think is legit or might think is crazy, that are we overvalued and it's a bubble, or are the companies just getting better? Because if you look at the revenue generated from some of these AI companies, if you look at the revenue per employee, for example, for some of these top companies, it's way higher than historically they've ever been. So maybe this isn't a bubble. Maybe they're just legitimately earning and deserving a higher PE ratio. But what do you think about that?
Yeah, I just saw. Let me hop in real quick. Sorry, Bryce. I just saw that a statement that said Mark Zuckerberg is paying AI experts $280,000 opening salaries to come over in his organization. Now, I'm hoping that's just because there's so few people that have that expertise that it's that high, and he's just pulling from all the other top AI companies. But for me, that was like, well, that's a pretty positive thing. How do you become an AI expert? So I just wanted to acknowledge that.
Yeah, I think that's a great question. How do you become an AI expert? Because, there's no training formally in AI. I mean, and by the way, Mark Zuckerberg just laid off like 600 people out of the AI division, right? So they're firing people constantly. They're always competing for labor with each other. But, generally speaking, like, I think the AI thing is good for the economy long term, okay, if this is widely distributed technology. And that's kind of where I get more skeptical of it, okay? If theoretically AI helps automate a bunch of processes, it's not just one guy at the top that owns a highly automated production system with no employees that collects all the revenue. If we all get AI tools that make us more productive and all of our pay goes up in kind of a broad way, then AI is good. It boosts productivity, it boosts economic growth, and increases real wages. Like, there's really no downside to that necessarily. The concern would be like, hey, all the AI stuff that I'm seeing right now, like the reality of AI today is that it automates white collar jobs away, right? That's why you invest in it as a company. It's not that, hey, my HR manager can do 5 times as much work, right? It's that I can do the same amount of HR with 5 times less managers or whatever, right? And so, like, I saw a stat the other day, and this is sort of my barometer for like white collar labor, like how's the job market doing? But that's just been getting fired because of AI for years, right? It's just like coders and paralegals and things like that. Your plumber's fine. He's not even affected by AI at all. Is you look at the number of people taking the LSAT, okay? Because, hey, if you want, you're getting out of college, you just got this credential, the job market doesn't look very good. Maybe I'll just go to law school, right? I'll get another credential, I'll take on some debt, but like hopefully things are figured out by then. It's kind of how people treat law school in the United States. A year ago, this month, like 6,000 people took the LSAT, okay? This year, 40,000 people took the LSAT. So it went up over 5x, right?
Wow.
That tells me that AI is not creating a bunch of new jobs or broadening the tools that people have, right? It's allowing companies to lay off white collar employees, right? So I'm skeptical of AI like creating this economic miracle right now. I think what it does is just concentrates wealth. It's great for like some companies, right, that pull it off. But broadly speaking, it just means less white collar people earning a salary, probably, at least right now. As far as the market goes with AI, yes, like these companies are seeing their revenue grow quickly. A lot of them have a ton of earnings. Like, again, I don't think Microsoft's going to go bankrupt here. Right? I don't think Facebook's going to go bankrupt. They're money printing machines, like no question about it. The problem is, okay, all that revenue is, again, coming from these like circular dealer financing situations where they're all tying each other together. They're all like in this incestuous relationship. And when you look at the assumptions that are going into this, right? Like OpenAI, for example. Okay, OpenAI lost like $15 billion or something this year. But they're saying, hey, we're going to, down the road, right, we're a growth stock. We start just making a ton of cash, okay? Well, they just took on like all this CapEx, like $60 billion in CapEx with Oracle. Next year, they're expected to lose like $27 billion. The year after that, they're expected to lose $45 billion. So where's the cash going to come from OpenAI to buy all this stuff from Oracle? It's going to come from Oracle buying more OpenAI stock, right? They're going to pay for themselves to like sell this product. And so, guys, it's kind of like circular financing. This is stuff that worries me, right? Because what you'd hope for is like, hey, oh my God, all these consumers are signing up for ChatGPT Premium and we're just raking in the cash. Like, that's not really what's happening here. 95% of these AI companies have, no profit, right? So, and the ones that do make profit it's from other businesses. So I'm not saying this technology never works out. Again, I think it will, but I think we're kind of in this period where there's this massive amount of CapEx happening under very optimistic assumptions. And all I see from AI on a daily basis is like video slop, right? I think we all, see this stuff showing up. This is why your power bill's going up. This is why, we've got, less water available in the aquifers or whatever. So, they need $2 trillion of revenue by 2040 or 2030, I apologize. So 5 years from now, under the most optimistic assumptions, according to like Bain and Company, they're short by 800 billion. Okay. And then on top of that, like half the power generation they need to actually like gear up. There's no way it comes online under any circumstance, right? It takes a while to build a nuclear power plant or like a coal plant or anything. So I'm having trouble like squaring the circle here. I just hear people yelling like fifth industrial revolution. It's changing the world. Shut up. You're a Luddite. And I'm not, I'm like skeptically optimistic, but I don't really see this delivering any kind of like value to society yet. I think it's just more kind of video garbage on all of our feeds.
And that's why what Jordy is so high.
Oh yeah, exactly. A lot of things are real high right now. I got two more questions for you if you'll just indulge me. I don't get to talk to an economist very often. Gold hit $4,000. That was a big deal in the news. I personally bought 1 ounce of gold in 2020, so I'm rich now, which is awesome. That has historically been a signal of defensiveness, like, or something's kind of going on, or there's chaos in the market, uncertainty in the world. But maybe it's something else. We also saw Bitcoin there. It's doing well, hitting all-time highs, having little drawbacks here and there, but that's nothing for Bitcoin. Why do you think gold hit that all-time high? Why is it having such a just remarkable year? And can it keep going to 5,000, or does this spell some kind of a looming disaster?
Oh, yeah, I think it's done really well for a couple of reasons. Okay, one is, gold typically does well when institutional trust is falling, right? Because like the dollar is worth a lot when we all trust in the idea of the dollar, right? So, and like, listen, we all know there's not a lot of trust in institutions for good reason, right? And hey, people are more and more concerned about the U.S.'s ability to manage all of this. Frankly, like Donald Trump attacking the independence of the Federal Reserve, right? Like, it's maybe you think it's great that Donald Trump is going to be in charge, but the point is then a Democrat's going to be in charge, right? So it's better to have like a disinterested technocrat like Jerome Powell in control of the Federal Reserve, because politicians always want to print more money. They always want to lower interest rates, and that can cause problems. So I think part of this is just lack of institutional trust. I think it's attacks on the Federal Reserve's independence that have driven up gold. Okay. The other thing that I think is happening here is internationally, countries are diversifying their reserve assets, and Bitcoin is also a reserve asset, sort of, right? We kind of think of it the same way as gold. So, let me like put it this way, okay? I mentioned like 50% global market share for the dollar, right? It's insanely dominant. The trade-off to that is the financialization of the U.S. economy that I mentioned, which is also at this point unsustainable. We're taking all these measures like tariffs and reshoring and, protectionism and whatever else to try and like reverse that trend a little bit. And so I expect the dollar as a reserve currency to fall in relative status. I don't think it's going away as a reserve currency. There's no way, nobody else can replace it. But instead of 50% of global transactions, maybe the dollar falls to 40%. Okay. The dollar weakens a little bit. What picks up the slack there? Probably the euro a little bit, probably other fiat currencies, but gold is a natural. It's always been a reserve currency. It's been a reserve currency since the beginning of time, okay? And it's not going away. And what's nice about gold is that it's what we call a neutral reserve asset. So one of the reasons people are upset about the dollar is it's not, there's the trade tension. There's us actually trying to reduce like the trade deficit and all of that. Part of it too is just people see us using sanctions as a weapon, right? It's great that you take dollars and you invest in U.S. Gold doesn't pay you an interest rate. The problem is, though, if you hold a bunch of treasury bonds, the United States government might just confiscate all of it like we did to Russia. Okay. or they might just sanction you into the ground if we don't like what you do politically. And so countries see this and say, hey, 50% of our Forex reserves, that's too much in dollars, right? There's just, the world's chaotic. The United States is swinging around sanctions like crazy. Maybe we need to pare that back a little bit and buy a bunch of gold instead, right? It's because there's no quid pro quo with gold. So I think it's the combination of those things that's driven up gold prices. And yeah, there's kind of a tailwind to gold going forward. By the way, like all the central banks are printing money again, right? They've lowered interest rates. Gold goes up in that situation as well. So I think there's kind of a confluence of factors that are positive for gold right now.
All right, I got one more question for you. There's some talk that I've heard around the investor Wall Street world, something called the debasement trade. And I think this kind of relates to what we're talking about gold. We're talking about the $38 trillion in debt. Many people, when they look at the debt, they say, okay, well, the U.S. has one of three options. They can either, how do you pay it back? How do you get right again? Well, you could default on it. That's not going to happen because then you get World War III. You could try to you produce your way out of it, meaning just our GDP just explodes from something. Maybe it's from AI, maybe it's from some clean energy revolution. I'm not sure. And we get our GDP up enough to not make it a big deal. And then the last option, which seems like it's kind of going this way, is we're just going to debase the currency until that debt's not a very big deal. This is leading people into saying, hey, something like gold, something like Bitcoin, these kind of fixed assets, maybe we just put our money in that, do the debasement trade, because it sounds like the government, the Federal Reserve, they're going in one direction and they're going to send fixed assets to the moon because they're not going to start printing. Do you think there's anything to that sort of debasement trade idea, investing in fixed assets? And is that kind of the path you see going forward for the government? Just, hey, we're just going to kind of slowly debase the dollar to try to stabilize the situation?
Yeah, I'd point out, right, like what's the other major fixed asset that everybody owns is housing, right? So like real estate. So yeah, Listen, I think the whole history of the world says that the government takes the easy way out and prints money, right? So right now, guys, like, to be honest, things are going fine. There's not really a huge, I don't think we're going to default on the debt. I don't think that that's going to cause a death spiral in the United States. I think we're fine right now. Okay. But what happens if there's another giant pandemic? What happens if there's a giant war? What happens if, the attack on our infrastructure? What happens if, go down the list, right?
Jerome, load up the printer.
Yeah. So what happens is historically, okay, there's the public facing dual mandate, which is, stabilize inflation, like keep inflation low and maximize employment. Okay. That's the PR dual mandate. Okay. The real dual mandate is bail out banks during financial crises and make the government debt affordable. So, the reality here is, like, if there's an existential problem that comes up, the Federal Reserve is going to print money. They're going to bail out the U.S. government. And so, yeah, I think the history of the world says they're going to print more money. Inflation's still 3%. They're already cutting, right? They've given up the 2% target here. So, yeah, I would be concerned about currency debasement, but it's also been happening since the creation of the Federal Reserve, right? There's nothing new about. It's been happening since, the Roman government would debase the coins with cheaper metals. It would happen when people were clipping the coins to make them slightly smaller, right? So we've been debasing currency for forever. It's the easy way out. The last thing I'll say on this, okay, is that, and this comes from Milton Friedman, and there's things I disagree with Milton Friedman on, but I think this is such a key point, which is that when we talk about tax and we talk about government spending, like, really the actual tax is the spending itself. Okay. It's the spending that's the tax. As soon as you print the money and spend it, basically one of three things has to happen. One is you actually just pay for it by taxing it out of the population. Okay. Two, you borrow money, which just loads the tax on the future generations. Or three, you just debase the currency. Inflation is the secret tax, right? So it's actually the money that they spend that taxes all of us, because it dilutes our purchasing power. And yeah, inflation is the easiest way for them to tax your wealth away. So I I think it's a kind of a key point. We talk a lot about like deficits and debt and everything else. It's really spending that's the tax. And you'll notice spending never goes down ever, right? Maybe the deficit fluctuates a little bit. Maybe we add a little bit less debt. Spending goes up every single year. So, I mean, that's the real tax on all of us.
Well, I tell you what, Bryce, every time you come on, not only do I have my mind blown, but I think all of our audience does. Jordy, your questions were phenomenal. Thank you so much. I've been chomping at the bit to get you going with Bryce there. Bryce, before we go, I think everybody just wants to know, what gun build out are you working on right now? Are you, what are you doing in terms of your training? What do you got going with that aspect of your life?
Yeah. So, I've been doing a lot of pistol shooting this year. I just haven't really made it to do any like rifle classes. And I have an outdoor shooting range like an hour away in Seguin, Texas. So it's a little bit hard to get out and shoot the rifle, put the plate carrier on sometimes. But I have a gun club and I'm a member of like the private upstairs range. And what's nice about that is like, when I go there, there's usually nobody there, right? So I can go in front of the lanes, I can set up some targets and I can like actually shoot up there, which is great. And like not just a static way. So pistols have been kind of a natural transition with that. So been doing a lot of concealed carry draws and everything else. But the thing that's kind of been really fun this year, one of my pet projects, one is I have a Smith & Wesson TRR-8. So if anybody knows what this is, it's the SWAT revolver. Okay. Basically Smith & Wesson designed this for the SWAT entry team guy with the shield because like semi-automatic handguns and close retention could like malfunction on a shield, right? So 8 rounds of 357 Magnum. I've got an optic on that thing. 357 Magnum is serious business, right? That's a cool cartridge. So adaptable. So I've been shooting the double action 357 Magnum revolver a lot more. I think that's just such an awesome gun. I also have a 1911 that I decided to get back into. I sent it out to get the slide milled. They ruined the slide, right? No. So that I had this gun for like 13 years. The slide is complete junk now. So I had to go and buy another slide, get it blended to the frame. I sent it out to get milled for an acro. They're DLC in it for me. So I should get that back next week and I'll have a functional 1911 again. So it's kind of been like a retro year, modernized retro with the double action revolver and the 1911. But
modernized retro. That is Bryce Gill TT right there. Dude, yeah. I absolutely love it, man. I tell you what, I know there is a massive audience out there that is just waiting for the Daddy Fat Stats Substack blog where you do a blog on a finance and then a blog on firearms. Just go back and forth on that. And I think you throw in a little prepper stuff and then some international finance and dude, you've got 300,000 subscribers in like a year plus. That's it. That's my prediction.
Oh, I appreciate that. I hope I have the free time to like pursue something like that. And at some point in the near future, I just got married. There's probably some kids on the way at some point, right? I'm very busy in my job as Economist right now. So, down the road, I'd love to pursue something like that.
That's awesome.
We'll just get you back on then. It's all good.
That's right. You'll do your blog entries with us, man. Bryce Gill, ladies and gentlemen. Bryce, thank you so much. It's always just a real pleasure and a treat to have you on. Thank you.
Absolutely, guys. Always good to see you. Happy to do it anytime and have a great weekend.